Warren Buffett, one of the wealthiest individuals globally, primarily due to his leadership of Berkshire Hathaway. This holding company owns a variety of other businesses, including Geico, Dairy Queen, and a significant railroad, along with substantial stock in companies like Apple and Coca-Cola. As these companies perform well, Berkshire Hathaway's stock rises.
The more money you make, the more you have to pay in taxes, right? Well, not always.
Warren Buffett still pays a lower tax rate than his secretary.
She pays at twice the rate I pay. I think that's outrageous.
When Buffett took control of the company in 1965, a single share was worth $19. Today, each share is valued at nearly $500,000. Buffett possesses almost 240,000 of these shares, which forms the basis of his immense wealth. Despite this, Buffett has often highlighted a critical issue. He pays a lower tax rate than his secretary.
Warren Buffett still pays a lower tax rate than his secretary.
She pays at twice the rate I pay. I think that's outrageous.
This discrepancy arises because his secretary pays income tax on her salary, while Buffett primarily pays capital gains tax on his stock sales, which is taxed at nearly half the rate of income tax. This difference underscores the broader issue of tax disparity in the U.S. Over the past 40 years, tax income for the richest Americans has surged over 400, while middle-class income has only increased by 50s. This growing gap is partly due to the different ways income is earned and taxed. For example, Morris, a retired Wall Street worker, lives off his stock market investments and pays lower taxes on his capital gains compared to income taxes on salaries.
I pay less in taxes than people that work for a living and make as much money as I do. I own stock in companies, Berkshire Hathaway and Amazon and Apple. I want to live in a country filled with a middle class of people who can all afford to shop in our businesses.
People earn a paycheck and pay income tax rates ranging from 10% to 37%, while investment income is taxed as capital gains, often at a maximum rate of 20%. For instance, Morris recently paid $50,000 in taxes on a $400,000 stock sale, significantly less than what someone with a $400,000 salary would pay. A significant portion of wealth, such as stock holdings, remains untaxed until sold. This system allows billionaires like Jeff Bezos, primarily valued through their stock, to pay minimal taxes. Some even take loans against their stock to avoid selling and thus avoid taxes. Another tax avoidance strategy is the stepped-up basis. If Buffett holds onto his stock until his death, his heirs would only pay taxes on gains from the time they inherit the stock, not from when Buffett originally bought it. This method, known as buy, borrow, die, is a key way the wealthy minimize their tax burden. To address this, lawmakers propose changes to the capital gains tax.
Some politicians are calling for higher taxes on the rich. And naturally, these proposals have unleashed a torrent of opposition, mostly from the rich.
President Biden suggests closing the stepped-up loophole and raising the maximum capital gains tax rate from 20% to 39.6% for individuals earning over $1 million annually. Critics argue this could deter stock market investment, but it is estimated to generate between $200 billion to $400 billion in tax revenue over 10 years. This approach aims to align the tax rates of billionaires more closely with those of regular wage earners. Although this would not completely solve the issue, advocates see it as a step towards a fairer tax system, addressing the growing wealth disparity where the rich continue to grow richer while others do not.